Frost. I'm the chair of the Legal and Taxation Group of the British Chamber of Commerce in Thailand, and I will be moderating this webinar this afternoon. Thank you very much for your interest and for joining us in this event. Our distinguished speaker today is Jonathan Stewart-Smith, who is a taxation partner at Mazars in Thailand. He brings with him a wealth of over 20 years' experience working in Thailand, including Thailand itself, and also in Japan, Singapore, and Hong Kong, advising companies on cross-border trade and investment matters. He specializes in international tax, transfer pricing, and transactions. He advises clients in most sectors of business and commerce and works with large corporations, funds, and entrepreneurs. He works with inbound clients on the tax implications of their trade and investment decisions and policies under local law and international treaties, as well as outbound investors on the global tax implications of doing business across borders. Looking at his academic background, after graduating from the University of Nottingham with a degree in industrial economics, he started his career in London, where he qualified as a chartered accountant and worked for 10 years. So without further ado, I'm going to hand you over to Jonathan. And thank you very much for being with us today, Jonathan, and for your very, very detailed and wide-ranging presentation. Thank you.
Thank you very much, Stephen, for your kind introduction. And thank you, everyone, for joining today. As Stephen says, we have a wide-ranging presentation today covering 5 topics. The first one is looking at new activities eligible for Board of Investment incentives, which have been announced this year. Then we look at the proposed long-term visa scheme, which you may have seen being discussed in the newspapers. And the reason we include this in a tax webinar is that there has been mention of a 17% income tax rate. So I want to look at that. Then we'll look at the new VAT law, which came in from the 1st of September this year and applies to foreign digital services providers. And then we'll look at the new transfer pricing documentation requirements. And we'll end discussing what the new global minimum tax proposals that have come out from the OECD, what they will mean for Thailand. So I'll aim to talk for 30 minutes or so and leave plenty of time for questions at the end. So let's move into the first topic, which is the new activities announced this year eligible for BOI incentives. So on this slide, we look at the first activity, which is digital activities. So here we have an amendment. So under the old law in the left-hand column, we can see that for digital activities, the old rule was that the software must be new and have never been launched before applying for BOI incentive. And the whole process of software and platform development must have been developed in Thailand after the BOI granted its approval. Also, the company must have purchased brand new hardware for the approved project, and the company must employ IT developers and pay them a salary of at least 1.5 million baht per year. So what has changed is in the right-hand column, and this was announced in September and is really in line with the government's Thailand 4.0 model of economic development. So the first phase, Thailand 1.0, was promoting agriculture, moving on to 2.0, light industry, 3.0, advanced industry, and now 4.0, promoting innovation and value-added activities. So there's this new BOI category, 5.10. The BOI cancelled the previous activities of software, e-commerce, so e-commerce no longer qualifies, and digital services, and announced this new policy, software and platform development for digital services and digital content. So the applicant can apply for the investment promotion, which existed before applying for the BOI. So this can be a pre-existing project that you've already commenced. You're still able to apply for the BOI incentive. Now, at point 3, the BOI states a number of categories which will not qualify. So these are, as you can see, website creation, data analytics without having any development of algorithms, tools, or software engines, distribution of products and services, transportation, lending money via a platform, language translation, computer graphics for movies, etc., video or sound editing. So those sort of more high-level activities will not qualify. So what will qualify? BOI is looking for innovation and value-added activities, for example, using algorithms, developing algorithms, tools, and engines. Continuing in this theme, point 4 is the applicant must submit a before and after comparison of the software platform features, number of IT developers, etc. And another new feature is that existing machinery can be used in the project. Traditionally, for BOI incentives, you have to use new machinery. So what's available? Well, corporate income tax exemption category A2, which gives you an 8-year tax holiday, and it exempts income. So income that the company earns from software activities, such as software development fees, sales of software, license fees, subscription fees, and advertising fees. But please note what is not included are commission fees, other service fees like consulting fees, and data distribution fees or analytics fees. So as it's brand new, we haven't yet seen many practical instances of companies applying for this incentive, but it is there. So if you're engaged in digital development activities, platform activities, this is definitely one to look out for. Then we have 3 other changes to notify you about. Number 2 is an administrative easing. So this is to do with the interaction of the BOI and the revenue department. So you have to apply to the BOI for non-tax incentives and separately apply to the revenue department for tax incentives. What's changed is that in terms of reporting. So under the old rules, the promoted person would submit the PND 50, which is the annual corporate income tax return, and the PND 1 core, which is the annual withholding tax return, in order to verify that it can claim the CIT exemption and reduction. But going forward, the newly promoted companies can submit those documents to the revenue department only, and then the revenue department will share that information with the BOI. So it's another example of the government authorities talking to each other in joined up government. Then item 3 is looking at TISO and IBC companies. So TISO, trade and investment support offices, which can provide services to third parties, and then the IBC, the International Business Centre company, which provides services to associated enterprises. So this allows TISO and IBC companies to do some money lending in a limited form. So they can lend foreign currency loans to associated enterprises overseas. They can lend Thai baht loans to associated enterprises in Thailand, and also Thai baht loans to associated enterprises in Vietnam and bordering countries. Now, please note this lending activity must not fall within the definition of a treasury centre, because that would require license from the Bank of Thailand. And finally, newly promoted activities which were announced earlier this year. So the first item we note there is in relation to care for the elderly. So senior hospitals and dependent care centres will be eligible for 5-year and 3-year tax holidays. And then secondly, the International Procurement Office, the IPO, is making a comeback. So the IPO used to be available under previous regimes, but it was cancelled and replaced by the International Trade Centre regime under the IBC. But now the BOI has brought back the IPO. So if you're engaged in purchase and sale of raw materials, parts and components, and you're selling them to manufacturers and distributors, then this is something that you should look at, because you may be able to claim incentives for it. And this applies both for trading within Thailand and overseas. So a number of new BOI incentives available. And let's move on to the second topic, so the proposed long-term visa scheme. So the status of this is it has been approved by the Cabinet in September, and the Cabinet has tasked the BOI with coming up with the detailed regulations and implementation programme. Thailand is looking to attract 4 categories of expats. So if we start in the top left, wealthy global citizens. So these are high income earners, frequent travellers, and what's required here is investment in Thailand of $500,000 in Thai government bonds or real estate, and you need to demonstrate annual earnings of at least $80,000 in the past 2 years and own assets worth at least $1 million. Then below that, wealthy pensioners, so at least 50 years of age, required to invest at least 250,000 US, again in government bonds or real estate, and earn at least $40,000 a year. Then on the top right, we start to look at, this is an interesting one actually, this covers digital nomads, so work from Thailand professionals. So this is, I guess, capitalizing on COVID, where we've discovered that actually, some of us can work from anywhere. All we need is a computer and a mobile phone. And some people, quite understandably, would be interested in working from Phuket rather than from a cold, wet climate. So the Thai government is looking to entice such people to come and work from Thailand. So they need to earn enough income to be financially secure, and maybe employees of large organizations who are close to retirement. So the exact details for this category remain to be worked out compared to wealthy global citizens or wealthy pensioners. Then the last one is highly skilled professionals. So this is where the low tax rate potentially would come in. So this is for professionals interested in working to come to work in Thailand in the kind of industries that Thailand is looking to promote. So as we were looking at earlier, so digital technologies, research and development, anything that chimes with Thailand 4.0. Also includes experts or researchers to work with government agencies or university lecturers. And the tax benefit, so this is, it actually ties in with the EEC, with the Eastern Economic Corridor. which already has a provision that if you work for a company in the EEC that is involved in the target activities, the targeted industries that Thailand is looking to attract, then international experts can benefit from a 17% flat rate of personal income tax. And it looks like that will also apply for this fourth category of highly skilled professional. So it seems like it will be quite narrowly targeted to people working in certain industries in the EEC. But as I say, the BOI is working on this as we speak, and more details will be forthcoming. Then we can move on to the new eVAT law, which came in on the 1st of September and applies to foreign digital services providers. So this is Thailand coming in line with international standards and recommendations from the OECD BEPS project, which came out in 2015 and we'll touch on later for the newest developments. But actually more than 60 countries worldwide have already implemented a similar law. So they collect VAT from foreign e-service operators that generate income in their territories. So the policy idea here is to level the playing field so that it's fairer between a provider in Thailand who has to charge VAT at 7% to a Thai customer, whereas under the old law, you could have a foreign provider of digital services based overseas who could provide the same service to a customer in Thailand and not have to charge 7% VAT. So there was a competitive disadvantage to local companies, which was unfair and has now been corrected. So Thailand is now in compliance with the OECD. In the right-hand box, we see the summary there. So who does it apply to? Well, it's to foreign electronic service providers, firstly, and secondly, electronic platforms. There's a revenue threshold of 1.8 million baht per year, which is the standard Thai VAT threshold, from providing electronic services to customers in Thailand who are not registered for VAT. So generally this will be you and I, individuals who are not registered for VAT, who download Netflix or TikTok. But it could also apply to some businesses if the businesses are not VAT registered. So if the business is VAT registered, this law does not apply to them. So where this does apply, the foreign e-service provider or platform needs to register for Thai VAT, file VAT returns monthly, and pay output VAT. However, the sting in the tail is that they cannot claim input VAT. So the obvious commercial response is that these companies would increase their prices, charge the customers 7% more, collect that from the customer, and then pay it over to the Thai revenue. So this is a bit of a more detailed explanation, some of which we've covered already. So the top left-hand box starts from 1 September. We've got the threshold. Moving on to the right-hand box, we give some more details. So electronic services are defined as a service, including intangible property, delivered through the internet or any other electronic network with a substantially automatic nature, which cannot be provided without using information technology. So it's got to be provided over the internet, and there has to be a high degree of automation in the provision of the service. So we give some examples in the bottom left box here. So download or playing games, music, movies, download stickers, streaming services, both video and audio. For example, live broadcasts of concerts, events, games, and also advertising, provision of advertising space on a website or application. So that would catch a Facebook or a TikTok, which generates a lot of its revenue from advertising. Equally important is what is not classified as e-services. So in the bottom right box there, so sale of newspapers, magazines, textbooks online are exempt. And also VAT on e-services will not apply to the sale of goods through an online channel. So if you log on to Amazon in the UK and you buy your favorite product from the UK and you ship it to Thailand and it's imported through Thai customs, that is not covered by this new law. That's covered by the existing law. So you may, depending on the thresholds, you may or may not have to pay VAT or customs on import. We give some examples of electronic platforms. So it applies to individual companies providing e-services, but also to the platform which hosts any market or channel. So that would include the well-known platforms, Apple, Google, Facebook, YouTube, etc. The Revenue Department is definitely moving into the digital age. Very impressively, it has developed a simplified VAT system for e-services, SVE, that allows the foreign e-providers to register, file returns and pay VAT, all electronically, so no paper involved. The deadline is the 23rd of the following month. So when you exceed the threshold or you expect to exceed the threshold, you have to register by the 23rd of the following month. All correspondence, tax audits with the Revenue Department will be done electronically. And then please be aware of penalties. So late filing can be subject to a penalty of up to 200% of the tax and a surcharge of 1.5% per month. So the Revenue Department has published a very helpful guide, which is available on its website, about a 20-page long guide in English. It includes plenty of examples, very user-friendly, easy to read and understand. And also the Revenue Department lists all of the companies that have registered so far. And currently there are 112 foreign companies which have registered for this new EVAT. So transfer pricing, new transfer pricing documents. So here we have a bit of a timeline on TP developments in Thailand. So back in 2017, Thailand joined the OECD's Global Forum on Transparency and Exchange of Information, and it joined the BEPS Inclusive Framework. And at the end of 2018, Thailand announced an amendment of the Revenue Code to introduce transfer pricing law, defining related parties, basically to be those with 50% or more common control. Then in 2019, Thailand introduced the transfer pricing disclosure form. We'll come back to that in a moment. And then last year we had a couple of ministerial regulations dealing with technical issues to do with how the Revenue Department will adjust income and expenses in a tax audit, and confirming that the threshold for the disclosure form is 200 million baht. And then this year we've had, in January, Director General Notice 400, quite detailed, explaining the transfer pricing methodologies that will be accepted by the Revenue Department. Also, interestingly, for the first time, acknowledging that when you look at comparables, there are circumstances in which you can look at overseas comparables. So previously the law was silent on this, but the Revenue Department in practice, their strong preference has been to use Thai comparable companies. But that notice, DGN 400, talks about circumstances where it is acceptable to use overseas comparables, which is very interesting. I think particularly for looking at transactional benchmarking, for example, for royalties or for interest rates, but potentially going further as well. It also confirmed that the preference is to file the TP disclosure form electronically. By exception, you can file it in hard copy. And then just a couple of months ago, we have 2 more notices from the Director General on local file requirements and CBCR, country by country reporting, which we go on into a bit more detail here. So the disclosure form talked about already. The local file. So for many years, companies have been filing or have been preparing local files in Thailand under previous revenue guidance. But now we have the formal ministerial regulation and notice, which is effective from this year. So for accounting years beginning January 2021, then the local file should be prepared. We now have details as to what should be included, which is broadly similar with the OECD guidelines. So you need to include a factual section about the company, so explaining what the company in Thailand does, its functions, assets and risks, how it fits in with the global group that it's a part of, describing all of the related party transactions, whether that's purchase or sale of tangible goods, or payment of a royalty, or management fees, or interest on a loan. All of that has to be described. The transfer pricing policy for each of those transactions has to be described, and it needs to have a benchmarking study. So comparing the company's transactions with independent companies and reviewing their profitability to try to justify that the company is pricing on an arm's length basis. The penalty for non-submission there is 200,000 baht as for the disclosure form. Now the disclosure form has to be filed, same deadline as the corporate income tax return, 150 days after year end. The local file, you wait for a request from the tax officer. So when the Revenue Department requests the local file, then you have up to 60 days to provide it. That can be extended in some circumstances, but our recommendation is that you prepare the local file ideally in the year. You start to prepare it in the year, so you have the intercompany agreements, you have the transfer pricing policy, and then as soon as the year is finished, then you complete the local file for the year by describing the results for the year and the related party transactions and the benchmarking. And then when you get the request from the Revenue Department, you have the local file already prepared. Then you're in a strong position from a negotiating perspective. You can hand over the local file to the authority and say, here you are, this explains everything and why we believe that the pricing is arm's length. So that's the disclosure form and the local file. Then we have the master file. So again, this is recommended by the OECD. We are still waiting for the secondary law to take effect here. But in principle, the master file should describe everything that goes on within the group. So at the parent company level, this should be prepared. So if you're a Thai headquartered group, then you should prepare it here in Thailand. If you're a Thai subsidiary of an overseas group, then this will be the responsibility of the parent company to prepare. And again, if the tax officer requests it, then it should be submitted. As I say, we are still waiting for secondary law on this. So this is the least developed area of TP law. Then finally, in the right-hand column, CBCR, so country by country reporting. We had a new ministerial regulation on this at the end of September. So this, again, is prepared at the head office level. The parent company, the ultimate parent entity, prepares this. And it's basically a summary in numerical form of the activities of the group. So it describes, well, it lists all of the related parties in the group by jurisdiction. And then by jurisdiction, it lists transactions with related parties broken down into tangible transactions, royalties, interest payments, service fees. So it's like a roadmap to the tax authority that shows you where in the group the company has revenue, where it has profits, where it's paying tax. So you can quickly see where the effective tax rate in each jurisdiction is. And if, for example, it shows that the company is earning a lot of profit in the jurisdiction and paying a low level of tax and has a small number of employees, then that's a red flag to the tax authorities to investigate further. So this will come in also from this year. So this is of immediate relevance for Thai headquartered companies who will have to prepare this. And then for inbound companies, then as I say, their parent company will have to prepare this. And they're likely, if they're over the threshold, which is 750 million euros, then they will have been preparing this for some years already and filing it in the parent company jurisdiction and exchanging it with all the tax authorities in the countries in which they do business. The change here is that going forward, they will exchange this information with the Revenue Department. So, for example, if you're a Thai subsidiary of a big UK group, the UK group will have been preparing CBCR for many years and exchanging it with tax authorities in the US and Germany and other countries. Going forward, they will exchange this information with the Revenue Department too. So the Revenue Department will have a picture of where the whole group earns its profits, pays its taxes, and it will be able to see how Thailand fits into that picture. Likely would lead to the Revenue Department asking more questions about the related party transactions. So that's a quick update on transfer pricing documentation in Thailand. So it's been a hot topic for a number of years, and it's only getting hotter. So definitely something to pay attention to and make sure you have documentation to defend yourself in a tax audit. This describes the local file that we've talked about. The benchmarking study on the right-hand side. So there is an exemption but it's quite narrow. So it's if your revenue in Thailand is under 500 million baht and you do not have transactions with companies in Thailand paying different tax rates. So there could be an arbitrage. If you have a Thai company with a BOI incentive and a Thai company without a BOI incentive, you could have an incentive to channel profits into the BOI company. If you do have that situation, then the exemption does not apply. If you have transactions with foreign related companies, the exemption does not apply. And if you have tax losses carried forward, the exemption does not apply. So moving on to the final topic. So there's been a lot of interest in the media in the last few months over a new global minimum tax. So what is it and what does it mean for Thailand? So the BEPS project actually started in 2013 out of a frustration within the European Union that the big US tech companies were making a lot of profits in the European countries, but paying very little tax through sophisticated tax planning. So this resulted in 15 action plans that were announced in 2015, which definitely have had an impact. So action 5 on harmful tax practices led to tax incentive programs being changed. For example, the IHQ program in Thailand being changed to the IBC program. And action 13 on TP documentation came out of that BEPS project. But that version 1, BEPS 1, did not tackle digital economy as such. It kicked the can down the road. But now we do have some outcomes. So now we have what's called BEPS 2.0. And consensus was reached quite impressively amongst 136 countries. So this is the inclusive framework of, it's actually 140 countries. So only 4 countries didn't sign up. They were Pakistan, Sri Lanka, Kenya, and Nigeria. So everyone else did sign up. Thailand signed up for it. And it's a new plan with 2 pillars, which will rewrite the international tax rules. Very ambitious timeline, with a multilateral convention being signed next year and implementation planned for 2023. So what do these pillars look like? So pillar 1 is all about redistribution of taxing rights. So what is this intended to attack? Well, let's use an example of the digital companies, the Facebooks, the TikToks, the Apples, which have a lot of customers, for example, in Thailand, and they may have an entity in Thailand, but they may not book their revenues, their sales revenues in Thailand, or their profits. The revenues and the profits may be booked elsewhere, maybe in a low tax jurisdiction. So what this tries to do is to say, hang on a minute, you have all these customers in Thailand. That's really where you're adding a lot of value, because you're mining, as we all know, mining the information about the users from Thailand. You know what we like. You send us adverts which are targeted based on the data that you gather about us. That creates valuable IP. Therefore, it's Thai source. It should be taxed. Some of it, at least, should be taxed in Thailand. So that's the policy objective. What's come out in the law? So it only applies to huge companies. So groups with revenue of more than 20 billion euros, and very profitable companies with a profit margin of over 10%. So this will only apply to 100 or so companies worldwide. What it does is it says 25% of the residual profits will be allocated to the market jurisdiction. So let's say you make your profit margin is 20% worldwide, so you're really profitable. Then we would say the excess profit is 10% over the baseline of 10%. 25% of that, so 2.5% of your worldwide profits should be reallocated from wherever they're earned, whether that's in the head office or in a tax haven. They should be reallocated to where your consumers are. And they will be reallocated based on revenues. So you look at the revenues in Thailand, for example, compared to global revenues, and you reallocate the profits to Thailand. So this should be good news for the revenue department. More profits should be allocated to Thailand that the revenue department can tax. Now, there will be some exclusions. So this pillar 1 will not apply to financial services companies or to extractive industries. There will be, to implement this, there will be a multilateral convention that will sit alongside tax treaties. And the quid pro quo, if you like, is that digital services taxes will be removed. So the US was quite annoyed by European countries introducing digital services taxes. And as a result, they imposed tariffs on the imports of French wine and cheese into the US. But Europe has agreed, and all countries who've signed up to this convention have agreed to scrap those digital services taxes. So they will go away. So that's pillar 1. What's pillar 2? So pillar 2, and by the way, pillar one is mandatory. So all the 136 countries that have signed up to pillar 1 will have to implement this. So this is coming. Pillar 2, on the other hand, is not mandatory. So this is the global minimum tax of 15%. So it applies, it's a lower threshold. So multinationals with turnover of 750 million euros, so still really big companies. And the idea is that every company around the world should pay tax of at least 15%, either in the source country where it earns the profits or in the parent company. So there are 3 new rules coming in to tackle this. And it is very technically complicated, but at a really high level, there's an income inclusion rule. So this says the parent company will apply a top-up tax. So let's say you're a Thai multinational and you have a subsidiary in the BVI and it pays no tax. If Thailand introduces this law, and it doesn't have to, but if it does, then Thailand would have the right to tax the profits earned in the BVI company at 15%. On the other hand, the subsidiaries also have a right to impose tax, either through this undertax payments rule, which is a domestic rule, or through a subject to tax rule, which is under a treaty. And the source country could either impose a withholding tax on payments made to low tax jurisdictions, or they could deny the deduction. So what does this mean for Thailand? So on one hand, Thai multinationals, as I say, may be subject to this global minimum tax, but only if the Revenue Department and the Ministry of Finance decide to go ahead with this rule. And it's not clear whether they would at this stage. But I think where we would have an impact is under the tax incentives. So the BOI incentives in particular. So if you think about it, if you're a UK company investing in Thailand and you have a factory in Rayong and you get a tax incentive and you're paying 0% tax, all good. The UK does already have CFC rules, so it might be able to tax the Thai profits, but actually the UK CFC rules have a substance exemption. So actually they probably wouldn't tax the Thai profits. So that's good news. You're paying no tax in Thailand, and you're not paying tax in the UK either. But if the UK introduces this global minimum tax, then the UK would have to tax the profits of your factory in Rayong at 15%. So then there's no point, right? There's no incentive because, okay, you don't pay tax in Thailand, but you pay tax in the UK. So developing countries have pushed back hard against this provision. And Thailand has actually made remarks to the OECD and has said, quite strongly and clearly, it said, moreover, investment measures should be considered as a basic right for developing countries. And countries like Singapore also are pushing back in this light. So there is a limited carve out that has been provided in the draft law, which says that if you earn a return of up to 5% of the carrying value of your tangible assets plus 5% of your payroll costs, then that sort of cost plus 5% profit will not be subject to this global minimum tax. And for the first 10 years, it will be a higher bar. It will be 8% of tangible assets and 10% of payroll, reducing over that 10-year transitional period. So that gives some carve out, but what if you're earning a profit higher than that? Well, then the excess profit is going to be caught. So if you are benefiting from tax incentives in Thailand and you have an overseas parent company, then this is something definitely to look at and model. So so let me wrap up there, and we do have time for questions. So please, if you have any questions, please let us know.
Thank you very much, Jonathan, for a fascinating presentation. No questions have come up so far, but perhaps I can try and kick things off. Can we go back to slide 21, please?
Sure. This one here?
Yeah. I think you said that pillar 2 of these proposals for global minimum tax are entirely discretionary. So it's entirely up to a country whether it adopts these or not, whether in contrast to pillar 1, which will apply to all countries that sign up to this treaty. How do you see the future developing, not just for Thailand, but as you rightly draw attention to, developing countries that do provide fiscal incentives to help their tax income, their economic development generally? Can you foresee a time when some of these provisions under Pillar 2 might become mandatory?
That's a great question, Stephen. Thank you. So I think if we look at inbound investment into Thailand, if we think of overseas companies investing into Thailand, so the big industrial economies will implement Pillar 2. So US, UK, Germany, France, China, Japan, they have come out and said they will implement Pillar 2. So then this will become relevant for Thailand because the incentives will come under pressure and may not give as much benefit as they did before. So countries are looking at other ways of providing incentives, so non-tax incentives. Singapore has been quite vocal about this. But I think if we look at Thailand, also Thailand has policy tools which it can use and already does use to attract investment. So with the BOI incentives, of course, we have the tax incentives, but maybe already even more significantly, we have the non-tax incentives. So we have the right to have 100% foreign ownership. We have the right to own land. We have discretion on work permits and work visas. We have incentives around customs duties. So Thailand and other developing countries have the ability to adjust those non-tax incentives to keep the country as attractive. Singapore is transparently talking about grants and incentives, so cash incentives to companies to invest in Singapore.
So perhaps, as you say, in some way, at some stage down the line, Thailand will have to think how it structures BOI privileges and the incentives that are given for both foreign and Thai companies to set up here. I mean, it's not very encouraging to say to, for example, a British company that you won't be paying tax in Thailand on the manufacturing business that you set up, but you will be paying 15% tax in the UK. That's really discouraging.
Absolutely, and the developing countries are pushing back strongly on this point. As I say, Thailand, has made a very clear statement that it believes that it is in the right of developing countries to offer tax incentives. And personally, I think it would be very ironic and unfair if the results of this initiative is to penalize developing countries. So if we, as I mentioned, the starting point of this whole project was the EU being annoyed with US tech companies not paying tax in the EU, if we boil it down to a headline. If the outcome is that Thailand and Vietnam and African countries are penalized, then that's a hugely unequitable outcome. And I think there should be an outcry about that.
Indeed. Okay, coming back to another part of your presentation about the VAT registration for overseas service providers. I think you said something like, so far, about 112 companies have registered.
That's right.
Now, the problem to my mind is, are there going to be any of these global giants, are they going to be dragging their heels in affecting registration or indeed paying tax? And if there are certain giants, you've named quite a number of well-known names, if there are a number of these giants that refuse to register or undercast their tax returns, how is the Thai Revenue Department going to recover money from them? They'll have to go off and sue them in their home country.
Good question. So on the website, we can see the names of the companies that have registered. And for example, Amazon have registered multiple times. I think they have 10 or 20 Amazon subsidiaries registered individually. And plenty of other well-known companies registered too. So I think the big companies are used to this by now, that they've had to register in up to 60 other countries that have similar rules. But it's a great question about detection and pursuit of liabilities. So at the moment, I think it's difficult, but it would be difficult for the Revenue Department to detect and then to impose liability. But the world is becoming smaller. There are mechanisms for exchange of information. So Thailand has signed up for the multilateral convention on mutual administrative assistance, which is basically exchange of information. So Thailand will be exchanging information more freely under that mechanism, under tax treaties. And I think companies also have to consider and do consider the reputational risk of if they don't register, and if that becomes public knowledge, then it can cause brand damage. So I'm quite confident that the big players are registering. I think it's more an issue for the smaller players of being aware of this new law.
Yeah, perhaps it's part of a larger issue, which is something that I have thought about very often over the years, that Thailand, and I'm sure you know this, Thailand has not signed any bilateral treaties with any other country for the recognition of civil judgments. So, for example, if you get a judgment in the Thai court against a UK-based defendant, you're not going to be able to enforce that judgment in the UK courts. You're going to have to sue all over again. And quite frankly, Thailand, in its current stage of economic development as an NIC, a newly industrialized country, frankly, should be reconsidering its policy in relation to mutual enforcement of civil judgments. This is the problem that I've seen in practice on several occasions. The difference is, of course, as I'm sure many people here will know, it's different for arbitration awards made overseas. Those arbitration awards are recognized by the Thai courts. So the issue that you have is limited to enforcement rather than re-arguing the merits of the case. But I find it very interesting, as you have highlighted, that in relation to taxation, Thailand seems interested to undertake a greater degree of participation and sharing of information with tax authorities around the world. Perhaps, you know, do you think things will change in relation to recognition of civil judgments? So, for example, Thailand gets, the Thai Revenue Department gets a judgment against a foreign company in the Thai court. Are we ever going to see circumstances where that judgment can be enforced without having to re-litigate the merits of the case in a foreign court outside Thailand?
It's a good question. I mean, the reason Thailand is exchanging more information about tax across border is that it has signed this multilateral convention to join the inclusive framework. Therefore, it is obliged to do certain things, to introduce country by country reporting, to introduce a common reporting standard, which will take effect from 2023, based on 2022 information. So that could be an interesting topic for a future discussion where we talk about Thailand exchanging bank account information automatically. Yeah. I think to your point about enforcing judgments, then, you know, unless there's some form of international agreement that Thailand enters into to allow that or to require that, then it may not happen immediately.
Yeah, indeed. Okay. Well, no questions have come up so far. We're getting towards the top of the hour, so perhaps I could close down the event at this point. I'm sure Jonathan will be very happy to answer and assist any of the participants if they would like to make any queries in writing towards him. His contact details are on the presentation, and I would like to say on behalf of the British Chamber of Commerce Thailand, thank you very, very much, Jonathan. It's been a very thoughtfully prepared and very detailed presentation on several different areas. And I hope it will be useful to everyone who booked for this event, whether they were able to join the webinar or not. So thank you very, very much, Jonathan, and we hope to hear from you as a speaker in the not too distant future. Thank you.
Thank you very much, Stephen, and thank you very much, everyone, for joining.